Okay, here we are. Welcome, everybody. It's Tuesday, April 9th. It's time for our weekly webinar. So let me first say that, as I like to tell you and remind you, this is live. And today's a little bit of a difficult week for me, or today's a difficult day. I've had two herniated discs since I'm about 25, 26 years old. And every now and then it flares up and bites me, and that's what happened this weekend. So I'm doing pretty good sitting in the chair here, but if suddenly I grimace or make a funny noise, that's where it's coming from. But, I didn't want to miss another week of not having the webinar. I really enjoy the time with you folks, and I know you do too, and I appreciate that. So we're going to do our normal format, and that's going to be, we're going to have about 15 minutes of the Slott updates, some good stuff again from the Slott group, and then we're going to talk about the markets a bit. And then this week's topic begins a three-part series where we're going to talk about financial education for college students and young adults. So this is how this came about. I was asked to speak at my kids' college through the Phi Theta Kappa organization. It's an honors program. And as I was putting the presentation together, and yesterday when I was speaking to the group, I really got inspired and was very interested in the feedback after the fact or during the presentation. And I thought I would share it all with you folks and put it out on YouTube for people to find it and enjoy. Because many of you come to me and nobody has ever said, "Gee, I wish I would have waited a little while to do these things," saving, investing, learning about things, being tax efficient, contributing to your Roth IRAs and tax efficient strategies. So what a great start for these young adults to be able to do that. So we're going to talk about that. We've got some upcoming events that I want to go over. And one of them I want to share with you, and I'm just going to jump in and share my screen here. Actually, I'm just going to share the screen, is next week is the tax filing deadline. So it's not only the tax filing deadline, but it's also the deadline for 2023 contributions to traditional IRAs and Roth IRAs. It's also the first installment, or the estimated payment is due for the first quarter of the year. So don't forget that either. If you're not withholding, if you're doing Roth conversions and you're not doing withholding and you have to make estimated tax payments, you want that done by April 15th. If you don't know what the heck I'm talking about, you really should reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com, because if you're doing Roth conversions and if you're doing these things that generate tax, you really want to take care of them in the quarter that you do them, or at least spread them out throughout the year. And you want to talk to a qualified CPA about how to pay these estimated taxes. So very, very important. I'll just list them again. What those dates are. So that's the tax filing deadline is, of course, April 15th this year. It's not always April 15th. Sometimes it's another day because it falls on a holiday, but it's April 15th this year. 2023 contributions to traditional IRAs and Roth IRAs have to be done prior to that date. I'm not talking about conversions. I'm talking about contributions. They are two different things. So 2023 contributions to traditional IRAs and Roth IRAs are due by April 15th. And then, of course, we have that estimated tax that's due by April 15th for the first quarter of the year. Okay. So I hope that's helpful. And we have other things coming up for us. So we've got live classes, the Changing World of Retirement class. The version that we have right now, I'm sure this is going to be the last time that this is going to be taught and available in this area. So on April 25th and May 2nd, we're going to have our Thursday series classes at Holy Family. And on April 30th and May 7th, we're going to have our Tuesday series. Now, don't worry about it if you haven't received an invitation, because we're going to send one out to you probably by Thursday of this week. So it's Tuesday. Probably by Thursday, you'll have that in your inbox, and you can sign up for that live class if you want to come join us. So it will be a live class. It won't be a webinar. It won't be recorded. We're not going to send it out to anybody. So if you want to be part of this class, you got to show up. You got to register, and you got to show up. We also have the Baby Boomer Dilemma that we're going to be screening on May 29th at the Newtown Theater. This is a really, really good movie that I enjoyed, and I want to share it with you. And I love the Newtown Theater, so you're going to get an invitation for that. Come out and join us, and I think you're going to enjoy that movie. It was directed by Doug Orchard, who's the same fellow who directed David McKnight's The Power of Zero, the Tax Train is Coming movie. And if you haven't seen that, you should see that as well. And I talked about, for the Financial 15 segment of this webinar, we're going to focus on financial education for college students and young adults, and this will be part 1 of 3. So today we're going to talk about banking, deposits, savings, and loans and debt. Really, really important stuff. Our next segment is next part, next week or the next time we're together, is going to be growing your money, and we're going to talk about stocks in particular. And then part 3, we're going to talk about growing your money again, and we're going to talk about bonds, mutual funds, and ETFs. And I'm going to share some critical items, some critical things that I think that you should be paying attention to, no matter who you are, but certainly when you're younger. But anybody who's planning for any financial event, whether it's buying a home, buying a car, retiring, significant financial events, I'll share some critical items that you should be paying attention to. So let's jump into our Slott Report part of the program here. So this is from our friend Sarah Brenner, and this is about, I'm sorry I didn't grab the title, but this is about reducing RMDs, this report. So Sarah writes, the markets continue to climb. This is good news for your retirement account. However, there is a downside. When you contribute to a traditional IRA or pre-tax 401k, you make a deal with Uncle Sam. You can get a tax deduction and tax deferral on any earnings in your account. However, eventually the government is going to want its share and will require funds to come out of these accounts. That is when you must start required minimum distributions, or RMDs. You may not need the money and you may not want the tax hit. Bigger retirement account balances can mean larger tax bills. Here are some strategies that can help reduce your RMD tax bite. So the first, and this is becoming very, very popular. You hear me talk about this all the time. These are qualified charitable distributions, or QCDs. So you could do a qualified charitable distribution or a QCD. If you're planning on giving money to charity anyway, why not do a qualified charitable distribution or QCD from your IRA? For 2024, if you were age 70 and a half or older, you may transfer up to $105,000 annually from your IRA to a charity tax-free. The QCD can also satisfy your RMD if the QCD is made before the RMD is taken, of course. That's important. Timing is important with RMDs. RMDs are very complex. Don't try to do these things on your own. But without the tax hit. So let me read that sentence over again so that you get the whole gist of the sentence. The QCD can also satisfy your RMD if the QCD is made before the RMD is taken, but without the tax hit. So you can take a qualified charitable distribution, send it directly to a qualified charity that can satisfy your required minimum distribution, and you don't pay any tax on that. It's a really great planning tool. QCDs are not available from employer plans. Really important to know that. You can use the still working exception. Are you still working after age 73? If you do not own more than 5% of the company where you work and the company plan offers a still working exception, you may be able to delay taking RMDs from your company's plan until April 1st following the year you retire. So even if you're at RMD trigger age, you can delay it if you meet these requirements. The still working exception is not available for IRAs, but if your plan allows, you can roll your pre-tax IRA funds to your plan and delay RMDs on these funds too. Just be careful. If you have an RMD for that year from your IRA, you must take it before you can roll over the rest of those funds. Number 3, consider a qualified longevity annuity contract, or a QLAC. A qualified longevity annuity contract, or a QLAC, is a product designed to help with longevity concerns. Any funds you invest in a QLAC are not included in your balance when it comes to calculating your RMD until you reach age 85. This will reduce your RMDs. Secure 2.0 has changed the rules for QLACs by increasing the dollar limit and doing away with restrictions on the percentage of the account limits. The maximum QLAC limit is now $200,000 per person. When you're considering a QLAC, however, pay attention to your thoughts about rising taxes in the future. So if you think taxes are going to be much higher in the future, you may not want to push out any portion of your money past, certainly to age 85. So that's a consideration to take into account. It'll reduce your RMD now, but maybe you pay more later. Convert to a Roth IRA. If reducing the taxation of RMDs is a top concern for you, you may want to consider a Roth IRA conversion or an in-plan 401k conversion. This is because you are not required to take RMDs from your Roth IRA or Roth 401k during your lifetime. Keep in mind you will need to take your 2024 RMD from your traditional IRA prior to converting to a Roth IRA. Let me read that again. Keep in mind you will need to take your 2024 RMD from your traditional IRA prior to converting to a Roth IRA. Folks, I repeated that because people who try to do these things on their own miss this all the time. And that makes your conversions very, very difficult. There is a big payoff, though. You will never have to worry about the tax bite of an RMD ever again if you convert to a Roth IRA. Good stuff, Sarah. So RMD rules for IRA beneficiaries in today's Slott Report mailbag. And this comes from Ian Berger. And here's our first question. My last remaining parent, my mother, passed away in May 2017. And my younger brother and I inherited her IRA, equally split into inherited IRA accounts. We were of the understanding we could handle required minimum distributions via the stretch IRA method, RMDs spread out over our expected lifetimes. The new laws that went into place in 2020 and 2022 have us wondering if we must change what we are doing. Can you please help us with this question? Regard, Eric. So really good question. Again, the RMD rules are confusing. The inherited RMD rules are especially confusing. So it's always good to check before you make any changes. So or start your RMDs. So here's the answer to Eric's question. The changes made by the Secure Act apply only to the beneficiaries of IRA owners who died after 2019. Since your mother died in 2017, you and your brother can continue stretching required minimum distributions, RMDs, under the rules in effect before the Secure Act. Remember, the Secure Act did away with stretch IRAs for other than eligible designated beneficiaries, and I'm going to remind you who are eligible designated beneficiaries today. All right, next question. I am trying to ascertain whether annual RMDs are required for inherited IRAs. In my case, I am the sole beneficiary and not disabled. My mother passed away in March 2020 and had begun RMD withdrawals across all her IRAs. I am age 67. And this is from Tim. The answer is, hi, Tim. You are considered a non-eligible designated beneficiary. Therefore, you must empty your mother's account by 12/31/2030. The end of the 10th year following the year of death. In 2022, the IRS said that non-eligible designated beneficiaries of IRA owners who died after RMD started also must receive annual RMDs during years 1 through 9 of the 10-year period. However, since the IRS has waived the annual RMD requirements for 2021, 2022, and 2023, so what he's saying is, since that requirement came out, the IRS has waived that requirement for those years. I don't know if I'm reading that confusingly, if it's written confusingly, but I'm going to clarify for you. So the IRS had these proposed regulations that came out, and they gave us a few different directions. First, they told us that required minimum distributions were required, or distributions were required. Then they came back and they said, well, wait a minute, they're not required. And then they came out with a proposed regulation that says, yes, in fact, an inherited IRA, if the decedent had began collecting their RMD, so if it was past the required beginning date, April 1st of the year following the year, in this case that they turned 73, or 72 before that, or, I don't think it would apply to 70 and a half, but then RMDs are required. But the IRS recognized that they completely confused the heck out of everybody. So they've waived that annual RMD requirement for 2021, 2022, and 2023. So we don't know if it's going to happen for 2024 yet. But if they're waiving the penalty And that's really what they've done. They've waived the penalty for missed RMDs, just in those inherited IRA accounts, not your regular IRAs that you own, just those inherited IRA accounts where you're now required to take required minimum distributions under the Secure Act and under the proposed regulations. They've waived that penalty, therefore really have waived the requirement. We don't know yet if they're going to do that for 2024. So Iron writes, keep checking the Slott Report to see whether 2024 annual RMDs are also waived. So we talked about eligible designated beneficiaries. So I just wanted to share with you. I keep this in my notes. I share it with you. I've shared this with you before, but when we're talking about eligible designated beneficiaries, there are only 5. That's surviving spouses, minor children of the account owner, disabled individuals under the strict rules of disability, Social Security disability, the chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. That's it. So I just like to share that from time to time. All right, let's talk about the markets, huh? So really difficult week in the markets last week. Markets dropped overall about 1%. But a lot of the indices were still approaching all-time highs or hit all-time highs. And we had some interesting data come in. So the ISM manufacturing report, the manufacturing moved back into this is what our analysts are saying. The manufacturing moves back into territory depicting expansion for the first time since September 2022. So that's growth. By moving up 2.5 points to 50.3. New orders also moved back above 50, rising to 51.4 from 49.2. Prices also rose, moving up 3.3 points to 55.8. So what does that mean? The improvement in the manufacturing sector speaks to the health of the economy. Growth continues, but the concern may start to come in the pricing component that indicates upward pressure on inflation could be beginning. So what does that mean when we start talking about rate cuts and things like that, when we still see these growth numbers in the economy, and really surprisingly so, it's not looking good for rate cuts anytime soon. And then we also had ISM services. This service index dipped slightly but remained in territory depicting expansion. Again, growth. Moving from 52.6 from 43.4. New orders, however, rose 1.1 points to 56.1, while the prices index fell 5.4 points to 58.6. So what does that mean? The service side of the economy continues to grow, but may be slowing modestly, while the price component remains elevated, but the decline should help ease concerns that inflation may be re-accelerating. So we get some conflicting data there. All right, and then the labor report came out. And again, this was a bit of a surprise. A lot of people talking about the labor report. The Labor Department reported the U.S. added 303,000 jobs in March, well above the expected 200,000, while the unemployment rate dipped to 3.8% from 3.9%, where it was expected to remain. Now, someone might say they might adjust these numbers, and they might, but it's a much higher report than expected. Average hourly earnings were up 0.3% month over month and 4.1% year over year, the lowest year over year gain since June of 2021. So our analysts say the strong labor report added modest weight to the growing belief that rate cuts may be delayed beyond the June meeting. Market odds of a June cut dipped from close to 60% to just over 50% in the wake of the report. So if you're taking bets on this, the odds just went down. So what do we have this week coming up? Well, tomorrow we have Consumer Price Index. So that's inflation. That's the general report of inflation that we get. And again, with market odds of first half cut diminishing, investors will be keying in on this report to see if inflation is regaining its deceleration path. So what's that mean? Let's just see what happens. Let's see what the number looks like. Then we have Thursday, the Producer Price Index. This report likely won't get as much attention as CPI, but will still be an important one to watch for signs of inflation trends in the pipeline. So we'll have to see what happens tomorrow with inflation. let's talk about what happened in the markets last week. Specifically, the Dow Jones Industrial Average was down 2.27%. The S&P 500 was also down 0.95%. The NASDAQ was down 0.8%. And the mid-cap, so mid-sized companies, that was also down 1.88%. Russell 2000, which is small-sized companies, was down 2.87%. Really across the board, emerging markets were up slightly. And the 10-year Treasury was up slightly as well. So emerging markets was up 0.41%. And then the U.S. Treasury, so it's a 10-year issued Treasury bond, was up slightly, 0.2%. So not a lot with analyst reports this week, a lot of bullish discussion. But I wanted to share with you an interesting take after what you just heard about interest rate cuts being delayed and whatnot. I went and I'm reviewing different reports, and I came across Goldman Sachs, and I just wanted to share this one sentence with you. And Goldman writes, why we can have both strong growth and lower inflation. They say, we expect much stronger GDP, gross domestic product growth, this year than consensus, but nonetheless expect core inflation to fall meaningfully, enough for the Fed to cut 3 times starting in June. So Goldman Sachs is saying, forget about it. We can handle it all. And we're still going to see rate cuts in June. So I think that's interesting. We'll see what happens. And I really, again, not much to say from the other analysts that were different this week. But I thought the Goldman take was interesting. Okay. So now we're going to go into our financial 15. So give me a second just to key this up here. All right. So again, I'm going to share with you this PowerPoint that I put together for this group of students. So this is the financial 15 part of this segment of the weekly webinar. And if you haven't done so already, please hit the like, subscribe, and notification buttons so you always get notification when these new videos are posted. And we do break it up from the weekly webinars, and we break it down to these financial 15s, which are shorter segments. But we're going to have 3 segments here of this financial 15. And it is financial education for college students and young adults. So as I told you earlier, this really inspired me I was asked to speak at a local college for where my kids attend as part of the Phi Theta Kappa honors program. They wanted a presentation about financial literacy. So I put it together over the weekend, and I was really inspired. I was inspired by some of the information I pulled from the internet, and I had a chance to work with some of the AI tools. That was very cool and a lot of fun. And surprisingly, some of the math was wrong, but I was mostly inspired by the interaction of the kids and, just the really good questions and comments. So I thought that I would share that with you folks. Now, I know that you folks watching this live may be way beyond this, but you can share this with your children, grandchildren, people close to you, and folks on the internet. Hopefully you'll find this and gain something from it. So let me get started here. So this is financial education for college students and young adults, and we're going to talk about fundamentals. And this week, in this segment here, we're going to talk about banking, specifically deposits, checking accounts, savings accounts, and debt. And then in our next segment, part 2, we're going to talk about growth, and we're going to talk about investments and stocks, bonds, exchange-traded funds, mutual funds. I'm sorry, we're not going to talk about bonds and exchange-traded funds and mutual funds in part 2. We're going to talk about that in part 3. And also in part 3, I'm going to share with you some key items, or what I call critical items, that you should be paying attention to help things, help your situation as you're learning how to save, invest, and maybe save some money. All right, so let's talk about banking first. So banking is important. Banking has evolved quite a bit, since I worked at a bank, and I was a financial advisor at a bank for many years. But, I don't go into the bank much. Most people don't go into the bank anymore, and certainly the younger generation. So I'm talking to young adults who are 18, 19, 20 years old, maybe a little bit older than that, into their early 20s. But they're using their cell phones to pay for things. They've got Apple Pay and whatever version of Android is. I have an Android, but I don't use that version. But debit cards, all those things. So you've got to have some ability to deposit your money, either a direct deposit or you deposit your check into some type of bank. You want that bank to be safe, of course. Now, there are protections in place. FDIC, that is the Federal Deposit Insurance Company. I think that's what the initials stand for. But what that means is that all the banks pay into a required deposit insurance organization so that your funds in the bank are protected. So the protection levels go up to $250,000 per individual. It can be per institution. So if you have more than $250,000, you can learn how to break that up. But that's not most people's situation certainly when they're younger adults. But you want something, you don't want to go to Joe's bank. Pick a good bank that's going to serve you well. It's going to be convenient. It's going to have some safety. And the convenience is important because you want to be able to do what you want to do with your banking relationship, not have too many limitations. And I'm a big fan of multiple savings accounts. So when you're setting yourself up for financial success, one of the real important things to do is have goals. I see it with my daughter, my youngest daughter. She's 17 years old. I'm going to talk about this in a second, but until recently, she used something called Greenlight. And that's not an endorsement. I'm not recommending that you use this at all, but it was something that we chose for her to use. And there's a reason we don't use it anymore. But one of the things that she was able to do was split things up. She's saving for some time in Florida. She's saving for a trip. She's saving for different things. So she sets it up in different accounts. And that's really a good way to do it. So as soon as she gets paid, she goes in and she splits up her account so she knows that the money in her cash account is what she has to spend. And she can feel comfortable that she's not overspending. She's not blowing her money. She's also setting money aside just for future things that she wants to do. And I think that's a good way to set yourself up and to start doing these things. But here's the thing with your banking relationship. Banks have fees. Some banks have very high fees. Some banks will absolutely wipe out your account if you're not careful. And you have to be careful and you have to monitor this. So I think very few people print their statements and go and reconcile them like they should. But you should be looking every day or often on your bank relationship online. Check your bank relationship. Make sure that you don't see any charges that you shouldn't be seeing, including bank charges. It's not just, somebody in a different country or a different part of the country ordering something that you didn't order. Make sure the bank isn't hitting you with a $35 fee, because suddenly those $35 fees can just eat up your account. My oldest son learned this the hard way. He opened up an account at a local bank. He had a debit card. And he would stop in at 7-Eleven on his way to school every morning, and he would get a cup of coffee. Well, that coffee cost him 99 cents or whatever it was, but the bank was allowing a transaction to go through on his debit card even when there was no money in his account. Now, shame on him for not keeping up on the balance of his account, but that happens sometimes. But the bank allowed him to do what? They allowed him to overdraft that account, and he was hit with a $35 charge every time he bought himself a cup of coffee. So you do that every day for a while before you get your statement, or you're not maybe paying attention to a phone call from your bank, and a cup of coffee costs you $36. So that's not worth it anywhere. I know lattes and things like that can be expensive, but nothing is as valuable as to cost you $36. So you got to pay attention to those fees. Know what they are. Ask what they are. And find a bank that maybe isn't going to charge you any fees, or maybe you have to have a minimum deposit in there, and that's your floor. That's what you keep in there. But pay attention to those fees. Now, listen, don't beat yourself up if suddenly you get hit with a fee. If you make a mistake and you get caught overdrawn or something like that, and you have to pay a fee. First of all, if it hasn't happened before, ask the bank. The bank might refund that fee. They often do that. Now, if you're a repeat offender, they're not going to do that, because banks are profit centers. One of the things, there was a professor there who was who was there at the school yesterday during my presentation, and we were talking about banking a little bit. And he reminded the group here. He said banks are profit centers. They're there to make money. There's a few ways that they make money, and they earn interest on your deposits, and they pay you less interest than they earn. Sure, make interest on loans. Yes, they also make interest on fees. Make money on fees. So you've got to be careful about what those fees are, and you've got to track them. So that's why that's in red. All these things are important. Safety, convenience. You want to have a checking, a deposit, a debit card. I don't know. There was one young woman who said that she writes checks. I jokingly said, I hope you don't do it at the grocery store, because we've all been behind the person who writes out the checks in the grocery store. No offense if that's you listening right now. But most of us use debit cards or Apple Pay or Android Pay, whatever that Android wallet, I think it's called. But all that's great. You want to have the safety, convenience. You want to have those different accounts. You want to have the different savings accounts if that works for you. But pay attention to those fees. And I said to you, you might want to open up different multiple savings accounts for multiple goals, but don't do that if they're going to charge you for every account. So, and you can't maintain a minimum balance. So all these things I'm talking about, I've got 3 goals. I want to buy a car. I want to go to Costa Rica. I want to do this, whatever that third one is. And therefore, I want to start saving in different accounts. That's a great idea, but you don't want to do it if you're going to get charged for each account. Maybe you use a program to help you, or a website to help you divide up those goals and those savings goals. You don't want to pay those fees, because I'll share with you the example of my daughter. We used that Greenlight app and debit card because that helped her. I guess we started that when she was about 15 years old, 14 years old, something like that. That helped her manage her money in the meantime. But they were charging her $5 a month. So I said to her, honey, I don't know if you want to pay $60 a year just for this convenience of this when you can just have it through the bank. She had an account at the bank. So it took her a while, but she got tired of paying that $60 a year. So, about 3 years of $60 a year, that's $180. That's a lot. So pay attention to those fees. Let's talk about what money should be going into your bank accounts. So let me move myself out of the way here. All right. So when you're with your banking funds, these should be liquid funds. So this is money that you don't want to lose, right? So you don't want to take your stock investment money and take, that's not your, how can I say it? That's not your risk money. So these are not investments. We want to focus on interest rates, and we want to focus on terms. I'm going to talk a little bit more about what I mean by that. But when we're looking at your banking relationship, safety, convenience, fees, now we're saying, okay, I'm comfortable with my safety. I'm comfortable with my convenience. I understand the fees. I'm going to minimize or not pay any fees. Now I want to start saving money in here. What should I be paying attention to? Now we're talking about interest rates and terms. Now, folks, if you're just listening to this and you're 18, 19, 20 years old, don't feel bad if you've never thought about this before and you already have money in the bank, because I see people who are decades older than you who have significant amounts of money in their bank accounts, and they're earning very, very little interest, 0.25%, 0.1%. Banks, I just can't believe the small amounts of interest banks are paying today. Here it is, April 9th, 2024, with the U.S. Treasury rates as high as they are. So you can purchase a 6-month U.S. Treasury bond right now for about 5%. Yet some bank accounts, money markets, are over 5%. Yet some bank accounts are still under 0.25%, 0.35%, 0.15%. So the bank isn't going to just hand you these interest rates. You have to be able to research them and ask and make sure that you're getting the best interest rates you can. And terms, what do I mean by terms? Unless you're willing to park your money somewhere for, say, a year and purchase a 1-year certificate of deposit, a CD, you may not want to do that. So be aware of what these terms are. The term means if I put my money into this certificate of deposit, for example, how long do I have to hold it? Do I have to hold it for 6 months? Do I have to hold it for a year? And then what if I need that money before that? These are the terms you want to check into. If I've got a 1-year CD and I have, $500 in there, and I need it prior to that 1 year, what does that mean to me? Are you going to keep some of my money? Or are you going to keep just the interest? Usually it's just the interest. But you're giving up something if you break that arrangement early. You violate those terms early. Loans, also very important. What's the interest rate and what are the terms? These are the things that we want to pay attention to. I just saw a woman on Instagram who was complaining about a $1,500 car payment she had for a truck that she bought. Maybe you saw this, and it was something like $85,000 when she bought it. So first of all, holy cow. It turned out she had a 10% interest rate over 7 years. And she was complaining because she said, I've paid this thing off for X number of years. I don't remember what it was, but it's barely moved. I think she had paid $50,000 toward it, and it only dropped $10,000 in value. Now I'm working from memory, and it was probably 10 o'clock last night when I was watching this. So, but they're the kind of things that can happen if you're not paying attention to your interest rates and terms on your loans. So let's talk about that a little bit more. Let's see if I can come back here. So again, so in banking, and you're talking about your liquid funds and savings. Now, if you're listening to me and you're older than college age or young adult age, so older than if you're closer to retirement, the short-term money I'm going to talk about right now doesn't apply to you. I'm talking about younger adults here. So short-term needs for younger adults really could be 6 months to 3 years. And that's, again, money you can't afford to lose. Why do I say 3 years? Because there may be things you want to do. And actually, we do treat it the same with retirees as I'm talking about it, because we have these segment 1 accounts, and that's very short-term money. But when you're thinking short-term needs, most of the time we're talking about 6 months to 1 year. But I want these younger folks I want them to take risks and invest, but I also want them to make sure that they have the money they need in the short term so that they're minimizing the use of credit cards. You're going to see the high interest rates on credit cards right now. It's astounding. But I want the younger savers and younger folks to start building up these short-term savings accounts so that they don't have to use things like credit cards. So short-term needs, 6 months to 3 years. Again, money you can't afford to lose. Get as much interest as you can. It's free money. Think of the interest as free money. So I gave some examples here. And let me get rid of myself just so you can see the references, where this came from. But get as much money as you can. It's free money. And here's an example. Today, a 6-month treasury bill. So that's a bill, a bond. It's a short-term bond that's issued by the U.S. government, still the most secure issuing agency in the world. And as of Friday, when I pulled the information for this, it was at 5.34%. That means $1,000. You're earning 5.34%. Over a year. That asterisk is there because that assumes that you're reinvesting that 6-month treasury bond again for another year. Well, you earned on that $1,000 $54.73. If you did a 1-year CD, that would be 5.05%. You would earn $51.69. So what I want to illustrate here is that if this was just passively put into a savings account, and maybe you're earning 0.25 or 0.35%, that'd be much, much less than the $54.73 that you could earn by using a 6-month treasury bill, or even a 1-year CD, or even a good money market account. So this is not a recommendation to buy, sell, or hold a 6-month treasury bill or a 1-year CD or even a money market account. I'm just using these things as an example. Now, go to the CD for a second. $51.69. You're getting 5.05% over a year. So obviously the numbers are higher than, because of compounding, but compound interest. And it depends. CDs are different. That's another thing you got to pay attention to. Sometimes they compound monthly. Sometimes they compound daily. So you've got to ask, these are terms. So what does that mean when something compounds daily compared to monthly, it means that 5.05% is applied every day, and new interest grows on top of that 5.05 either every day or it's applied every month and it grows on top of it every month. And the amount that you'll get in the end if it's compounded monthly will be less than the amount if it's compounded daily. So that's something also in those terms that you want to pay attention to. But if you're getting an extra $50 a year on your money and you're saving yourself $60 a year, right? Using the example of my daughter who was now no longer paying that fee for that program that she was in. So that's $110 a year. That's significant, right? And that's better. That really is free money. Better that it comes to you than the banking institution. Listen, I invest in some banks, and I want the banks to perform well, but I want you to perform better, right? And be able to keep that money and earn that money for your accounts. Now let's talk about loans. So that's what we just spoke about were savings and deposits. And again, you want that safety, convenience, and get as much interest as you can. Pay attention to the terms. And those little incremental things will help grow your money over time. And they're very, very important. But pay attention to this, if nothing else, because loans will suck the savings and the money. They are money stealers. It just takes it from you. They're absolutely necessary. There are times in your life when it's going to be necessary to have loans, mortgages, car payments, buying a car, things like that. Of course, you could buy a car without a loan. And if you can do that, that's great. Most people, when you're younger, you can't. But I applaud you if you can. And that's better if you can. Student loans, obviously, big problem in our country. But you got to manage the student loans as well. So you may not want to buy a car on a loan if you already have student loans. You got to manage this debt and try to keep it as small as possible. So pay as little interest as you can. Debt steals your money. Consider the cost of the items you're purchasing or you're committing to with financing costs included. I'm going to say it again. Consider the cost of the items you're purchasing or that you're committing to with the financing costs, the cost of debt included. I'm going to give you an example of what I'm talking about. Here's the average credit card debt. I'm going to show you here just so you have where the information came from. It coming from the Federal Reserve for accounts with balances that assessed interest from November of 2023. So it's actually a little higher today. But the average credit card interest rate in the country is 22.75%. Shocking to me. It's not what I expected to see when I researched this. 22.75%. So if you're using credit cards to purchase things, whether it's your food, I said, well, first of all, I did a little poll. Well, really, I asked my daughter when I was putting this together, I said, what do college kids spend if we use $500? What are college kids spending $500 on? And she was texting her boyfriend to try to have this conversation as well. But it really came down to, well, probably more than anything, food. Whether it's dining out or just buying groceries, kids are putting their food on credit cards. So I asked yesterday to the group of students, and sure enough, they raised their hand, food. So I want you to think about that because let's talk about a $500 credit card balance, a $500 credit card balance. If you just pay the minimum payment of $10 a month, that's the average minimum payment. So you got a $500 balance. You're paying $10 a month minimum payment. Let's look at how long that's going to take you to pay off and what the cost is going to be. So here we are. Just at $500 balance, paying $10 a month. It will take 52 months, approximately 4 years and 4 months, to pay off the $500 purchase. The total interest you're going to pay on that $500 purchase is $261.25. That means whatever you bought, whether it's food, whether it's, whatever it might be, the total cost of that is not $500. It's $761.25. $761.25. $261 added to that $500. So when you're ready to put your credit card down, when you're ready to run it through the scanner, it's so easy. Just tap it on the machine. think about, is this set of clothes, sneakers, leggings, whatever, is this worth $760 to me? Even if I'm willing to pay $500, is it worth that extra amount? That helps you. I think that helps you. Let's talk about credit scores. This is something that you should be keenly aware of. Pay attention to your credit score. You want to work to build your credit score. You can get your credit scores if you're using a credit card. A lot of credit cards will help monitor it. You should pull your credit score once a year. You can do that for free. Go on. I think it's freecreditscore.com. Be careful because there's some scam sites out there. But pay attention to your credit score. Work to build your credit score, make it higher, and strive for a higher credit score. Because this is why you should do that. I want you, let me come out of here again. I want you to look at the different interest rates for different scores. So I hope you see my cursor here. So the lower credit scores here is deep subprime. That's the lowest. And it ranges up to, I think it goes to 900, but it shows here 850. So maybe it's just 850. But a lot of people are in this category, this non-prime. Maybe when you're first getting your credit together. There was a young woman in the presentation yesterday who told me that her credit score was super prime, so she was in the top category. That's great. But even at super prime, for a new car, she's going to pay 5.64%. If she buys a used car, she's going to pay 7.66%. That's a lot of interest, folks. But let's look at where the average person is probably going to start out, and maybe if they had a ding or two in their credit, they could be at 14.12% for interest. That's the amount of money you're paying over the cost of the car to be able to delay those payments over time. So that may not sound like a lot to you. It sounds like a whole heck of a lot to me. But if you're buying a used car and your credit isn't perfect, you're maybe looking at something like this and maybe worse. So what is the effect here that we have on this? Go into the next slide. If we look at a used car and you buy that car for $20,000. I asked the group yesterday, does that seem about right, $20,000? They said, yeah, that seems about right. At 14.12% for 5 years, that monthly payment would be $678.94. Now, that's something you may not be able to afford, $678.94. So you might even want to make that a 7-year payment, which they'll let you do. They being the used car sales folks or the banks, they'll let you take it longer. It just means more interest. But if you're only able to do it, if you are able to do it for 5 years, you're paying $678.94 for that car. And the total price you're paying for that car is $40,736.40. Not $20,000. $40,736.40. So instead of getting, and listen, folks, I love buying cars, and I've had a lot of neat cars in my lifetime, and it can get really exciting, really fun. You think about, all the fun you're going to have in that car. But look at it sometimes and say, all right, I might be really excited about buying this car at $20,000. But first of all, have a real conversation with yourself about what $680 a month basically means. And then if you're past that hurdle, okay, I can afford $680 a month. What if you have a great job and you're ready for this? Is that car worth $40,736? You might want to handle things differently. And one of the ways that you can do that is save up more now when you're younger and you've got time to build something up in a savings account. And now reach for higher interest. Ask about higher interest. Make sure you understand the terms of your savings accounts. Make sure you understand the fees in your banking relationships. And for crying out loud, when you get into a loan, when you start using credit cards, make sure you understand the payments, not just the payments, the interest that you're paying, the cost of the goods you're really buying, and the terms of that. Thankfully, when you're talking about debt, even more so than when you're talking about savings and deposits, all these things have to be disclosed to you. But here's the thing. It used to be that it was disclosed to you on a piece of paper. Now it's disclosed to you probably on your cell phone. And you just go through and you hit the agreement buttons, or, the check boxes, sign it right there on your cell phone. Do you really check it? If most people are being honest, they're going to say no, but check it, understand, make sure that $20,000 car is really worth $40,000 to you. When I was in my early 20s, I had an opportunity to buy a car that was very, very cool. It was a Porsche 928. It was very, very cool. A car I always wanted. And I remember standing in the kitchen in my condo and talking myself out of it because I really didn't need this car. I just wanted this car. And I worked through the math of what it was really going to cost me in other things I couldn't do because I'm spending the money on this really, really cool car. And the overall cost of the car, I broke it down and I said, I don't remember what it was, but it was, the interest rate wasn't that high for me at the time. But I talked myself out of it and decided against it. It was probably one of the best things I did financially or maybe I still have a cool 928, who knows. But really, sometimes you've got to bring yourself squarely on the ground and say, okay, this isn't the best financial decision. Now, I'm going to share another one. I had a relative call me one time and they said, hey, the neighbor down the street, her husband just passed away. He's selling a Ford pickup truck, a Ford F-250. And he said, I'm going to buy it. I want to buy it. It's $12,000. And I said, or it's $25,000, excuse me, $25,000. He said, so it's a really good deal. It's $25,000. So I'm going to take money out of my retirement account, red flag number one, and I'm going to buy this truck. So red flag number one, taking money out of my retirement account. Red flag number two, he was about 40 years old at the time. So not only is he paying tax on that money, but he's getting penalized, 10% penalty on that money. Red flag number three, he's buying it for a car. He's pulling it out for a car, which is a depreciating asset. In most cases, I know there's cars that gain value, but not this car. So 3 red flags. And I said, well, if you're comfortable spending $75,000, I really pushed it up for him, then I guess you should buy the truck. And he said, what do you mean? I just told you it's $25,000. I said, well, you're going to take that money out now and you're going to spend it. So you're never going to have that money grow for you. You're going to take it out now and you're going to pay tax on it and you're going to pay a 10% penalty. If it stays in the account and it grows, it might be worth $75,000 by the time you're ready for it. You're a young guy still. And he said, oh yeah, that makes sense. I didn't think about it that way. So when can I get my money out? He says. So he didn't listen to me. So he's probably out about $60,000 or $70,000, maybe $75,000 for his retirement to buy a truck. So that's probably not the best deal. But listen, here's the recap of today. Use your banking smartly. Pay attention to fees. Pay attention to your interest rate that your money's earning. That's free money. Let your money work hard for you and get as much interest as you can. Push the people who are doing it. Ask them, what's your best interest rate? Sometimes they just, they don't offer it to you. Even if it's not the highest interest rate you can find in the world, maybe they're paying you 4% and you get 5% out there, but you're comfortable with the bank. That's okay. You're getting something unless you want to move your money around. Maybe you learn how to do that later, but get the most interest you can. Pay the smallest amount of fees and hopefully no fees, and pay attention to terms on your banking relationships with savings and deposits. Certainly pay attention to debt. Debt will rob you of your future enjoyment of your money. Debt is necessary at times, but be careful. Be careful of the interest rate you're paying. Be careful of the terms, and look at your cost of the goods or the items you're purchasing, the total amount of the goods and items you're purchasing with the financing costs, the debt service, the debt cost. Not just what you're paying for it today when you hand or scan or tap your credit card. All right, next week, we are going to talk about growing your money. So next week, we're going to start talking about stocks. And the following week, we're going to talk about bonds and exchange-traded funds and mutual funds. I hope that was helpful. That's the webinar and the Financial 15 for today. If you have questions for me or would like to schedule time with me, you can do so at questions@attleborowealth.com. That's questions@attleborowealth.com. you can check out our website at attleborowealth.com, where you can find videos, past videos that we've done like this. Also, of course, our YouTube channel. There's a lot of videos. We crossed over 200 videos on our YouTube channel a couple weeks ago, so that's kind of fun. I really enjoy these videos and these webinars, and I enjoy and appreciate the fact that you take time out of your day every week. For you folks who watch it live, and for all you folks who watch the recordings, I appreciate you too. Have a great week. Take care. Bye-bye.